Good morning. First of all, thank you for inviting me out to present. I appreciate that. I have now been at John Gielman and Associates for 16 of their 44 years. We've grown to about 75 employees, and we now serve about 1,000 client families, which is really fantastic. Over our 44 years, the assets that we manage are somewhere between 900 million and $1 billion, depending on what that crazy stock market of ours is doing on a daily basis. So let's jump right into the presentation. This slide is a disclaimer, and really what this means is that this is a general overview of the topic. It's not specific to any individual investor. And the neat thing about our job is every client, every prospect has different facts and circumstances that we need to be aware of. And this, like I said, is a more general overview. For a specific client, it would be much more in-depth. So just a disclaimer there. Let's get into it. Satisfy your philanthropic goals and save some tax dollars along the way. Really, we're going to be dealing with some strategies. How do we save and mitigate some taxes while still gifting to your favorite charity or entity? Charitable contributions. The key here, and there may be some small business owners in the group, charitable contributions are not a deductible business expense for some of us that are sole proprietors or organized as an LLC or even a partnership. These are pass-through contributions, which means they have to show up on your individual tax return on Schedule A as part of your itemized deduction. So again, these are not business expenses. These will eventually show up on your individual tax return, not part of your business expense. Sole proprietor, LLC, and partnership. A lot of folks list charitable contributions on their P&L statement, but they need, like I said, to be added back onto your individual return under Schedule A. Partnerships, sometimes these charitable contributions get reported on the K1, the Schedule K1, and again, then they need to go to Schedule A. A quick reminder on this slide, no political donations still do not count, fortunately or unfortunately. S Corps and C Corps, that's a whole new ball game and definitely outside of the scope of this presentation. And I just wanted to mention that before we get into the nitty-gritty. What could determine my best and correct and most appropriate charitable vehicle? Size of the gift, obviously, if we're talking a few dollars in the plate at church or into the Salvation Army bucket at the holiday time, or if we're giving multiple thousands of dollars. Types of accounts that I have, that the donor may have. Is it an individual account? Is it a retirement account? Who the gift is for? What age we were at. Age 70 and a half is a real key. That's something we'll get to later in the presentation. And simple versus complex. How simple do we want to make it? Do we want to just use cash, or do we want to get into, for example, some type of trust? So lots of points and things to think about in determining which one is the best route to go. Cash, the simplest for sure. One thing to remember here is a few years ago, there was a very large increase in the standard deduction on our tax return. You can see the numbers there, almost 13,000 for a single filer, almost 26,000 for married filing joint. And really, when we do give cash, we need very, very accurate documentation. This has been a sore spot for the IRS and really a red flag. So one planning strategy and opportunity is maybe doubling up on a year when you are itemizing your deduction. So for example, on that last bullet point, if I plan to give $10,000 over the next 3 years, why don't I bunch those in 1 year and then skip the following 2 years? So give 30,000 in 1 year rather than 10,000 over the next 3 years. Get over that threshold of the 25,900 and itemize your deductions and get the benefit for the cash contribution in that one particular year. Another opportunity, long-term appreciated stock. This is if you might have a brokerage account with some nice winners that have done well over a year while holding that stock. Again, these are deductible if you itemize your deductions on that Schedule A. And of course, you could save on paying capital gains, which can range from 15 to 20%. So if we start on that far right column of that chart, you can see that, if I was to give $10,000, I would save $3,500 in taxes. But if I sold those securities and donated the cash from the sale, I would pay a capital gains of $1,200. So my net savings is only $2,300 in this example. The middle column, a little bit better. This is where I just donate the cash. I just write a check to my favorite charity for $10,000, save the $3,500 in cash, and that's my net savings. The first column, or the third one that we're talking about, is really a double dip, and you get to save tax twice, which is really cool. So it has to be a long-term security, more than 1 year. I save the $3,500 because I'm saving that in terms of the charitable contribution. And then I also save the capital gains tax because I'm not selling these. I'm actually donating the stock to the charity. So you see there, I get, in this example, about $4,700 worth of tax savings by double dipping and getting double the tax savings. Donor advised funds, again, we're getting a little bit more complex as we go here in our discussion. Again, for a larger gift, probably in the high hundreds or thousands. The neat thing about this is the donor gets to recommend and suggest the grants. So these funds can be done through various brokers like Charles Schwab or Morgan Stanley, Vanguard, Fidelity. There is a cost to do this, obviously, because it is more complex. The donor contributes, you get the full deduction in the year that you make the contribution. Hopefully, the assets grow. That would be good. That's the plan, tax-free growth. And then the donations happen and the charities benefit. So that's a very simplistic slide on how a donor advised fund works. It's a little bit more complex, but that's the general overview. Private foundation, like a donor advised fund, it's a private community foundation. The neat thing about this is there can be some family involvement. You can bring kids in, adult grandkids. There's a little bit of accountability. Maybe this private foundation is done for a charity that's near and dear to the family's heart. So it brings kids in, it brings grandkids in. It's kind of a neat way to bring the family together while still giving to charity. Charitable trusts, same thing, more sophisticated now. Two general types of charitable trust. There's a remainder trust and a lead trust, and they're really sort of the opposite. So let's start with the remainder trust. Whatever's left over goes to charity, but before the person passes, there is an income stream for the donor or the creator or whomever the donor wants to set up. The lead trust, exactly the opposite. Now the income stream during life is set up and goes to the charity. The remainder can go to a beneficiary, maybe a child, maybe a grandchild, maybe the donor itself. Now, the neat thing about this is that those income streams can be a fixed percentage or a fixed dollar amount. So maybe the percentage is 4 to 5% of the balance of what the trust is, or maybe it's a fixed amount that happens weekly, monthly, quarterly, annually. Some of the examples of this would be a CRUT or a CRAT. We've heard that, charitable remainder unit trust, that uses the fixed percentage, or a CRAT, a charitable remainder annuity trust, that uses the fixed dollar amount. So again, these are for larger gifts, a more sophisticated planning opportunity. Wow, look at that, some alphabet soup, what a mess. This is really some investment jargon and some charitable gifting jargon that we'll try and touch on during the next few slides. IRA beneficiaries. So IRAs, you can have traditional IRAs, Roth IRAs, SEP IRAs for self-employed folks. This is really a very easy, simple, effective flexible way of gifting. And you can change your beneficiaries literally by the stroke of a pen and redoing paperwork. So the neat thing about beneficiary designations is they trump the will. They bypass probate. And depending on what state folks are in, this probate process can be long, it can be fairly expensive, and it's public knowledge. So that's why a lot of folks enjoy this simple way of giving. For the most part, the distribution rule for charities is 5 years. And for the most part, again, 10-year distribution rule for a non-spouse beneficiary. You see that mostly for kids and grandkids. This was all changed at the end of 2019, a few years ago, with the Secure Act. And really what the reasoning was you used to have an IRA that a grandmother or a grandfather had, and the beneficiary was maybe a 15-year-old grandchild. Well, they could stretch out their withdrawals for their life expectancy, so maybe 70 years. With the way our government has been spending money, they want their tax dollars now, and really what the Secure Act did in 2019 was eliminate what we call the stretch. The next slide is IRA beneficiaries after the Secure Act. You can see the 3 different colors there. The eligible designated beneficiary in the first one really is spouses. So that's where the stretch is still available. We see that most often is when the husband passes and then the wife is allowed to stretch that out. So that green one is eligible designated beneficiaries. I apologize. Middle is where you see non-spouses, mainly kids, mainly grandkids. The red column there you see is where the charities are. So in the fine print there you see RBD, required beginning date. That age now is 72. It used to be 70 and a half when people with retirement accounts had to start drawing down and taking out required minimum distributions. That age is now 72. So when you see RBD, that is 72. Beneficiaries on non-retirement accounts. We get the question, wow, that works great for my IRA and my SEP and my Roth. What about my investment accounts or bank accounts? So neat way to, again, jump over the probate process or stay out of that process. You can have transfer on death, which is for investment accounts, just adding a beneficiary designation to an investment account. POD, payable on death, same thing, just adding a beneficiary to a bank account. So again, another way of simplifying the process. When one passes, it trumps the will and there's no probate process there. Qualified charitable distribution. I think this is one of our last slides. Here at JGUA, we spend a lot of time with QCDs. It's a very popular idea. It's used with required minimum distributions, RMDs, from IRAs. There's a little bit of that alphabet soup. Again, we mentioned that new RMD age is now 72. However, they left the age for these QCDs at 70 and a half, just to confuse us a little bit further. The neat thing about doing these QCDs is the charitable contribution goes directly from the retirement account to the charity. It skips the tax return. So some cool things that it does, it may reduce our Medicare premiums, Part B, if we're in the Medicare phase, by keeping down our MAGI, modified adjusted gross income. The other thing it does is keep our income down, and less of our Social Security is taxable. So if we're in the Social Security age, 62 to 70, that could help. IRMA, income related monthly adjustment amount. So this again is for Medicare. Part B premiums, Part A premiums, we may or may not know are free, but what we pay for Medicare Part B premiums is based on our modified adjusted gross income for 2 years prior. So what I mean by that is for 2022, this goes off of our 2020 income tax return and what kind of income we had in that year. So this slide is very important. We do a lot of this for our clients. It's a great planning opportunity for those folks that have charitable donations that they want to make. And that's it. Went through those very quickly. I thank you all for attending, and please, if anyone has any questions, look us up at JGUA, and one of the advisors will sure be able to help. Thank you.